Hi, today I am going to talk about how multinational corporations eliminate their foreign currency risk. The book talks about three types of exposures: transaction exposure, translation exposure, and economic exposure. Uh, and even though they might appear to be three different types of exposures, they are very linked to how a multinational corporation chooses to operate. And hopefully, after this video, you'll be able to see and understand what I'm talking about. Now, the first exposure that I'll talk about is transaction exposure, and it's very straightforward. It is the exposure that arises when a multinational corporation is operating and selling goods and services in another country's local currency. Let's take an example. Uh, let's say Boeing is selling an airplane to Chinese airlines, and they believe that the fair price or a profitable price for them would be 100 million US dollars. Now, the Chinese airline wants the pricing to be in Chinese yuan because they don't want any surprises, and Boeing agrees to that. Let's say at the point when the contract is being negotiated, for every US dollar you get 7 Chinese yuan. Now, between the contract signing and the final delivery and the receiving of the payment, let's say there's a time period of 1 year, right? Airplanes are big, and they take time to manufacture and so on and so forth. Now, during this time, if the Chinese yuan devalues, then Boeing will lose money. If the Chinese yuan strengthens, then Boeing stands to make money. So let's say the Chinese yuan devalued, right? Because that's what the Chinese have been doing, and let's say that's what happens. Now, if the Chinese yuan were to depreciate to 7.5, so for every US dollar now you're getting 7.5 Chinese yuan, then Boeing will not get $100 million. Boeing will get $93.33 million, which is 700 divided by 7.5. So Boeing just lost $6.67 million in revenue, and that could be really bad for them. Now, because they knew at the time of the contract signing that this could happen, they could enter into a forward contract or into an option contract and eliminate this risk. The good thing about transaction exposure is that it's very easy to eliminate. However, it's not free. There's always a cost to hedging. For example, if they entered into a forward contract and logged in the rates, let's say at 7.2, right? Then the additional that they are paying from the current spot is the cost of their hedging, right? Because it is possible that in a year's time that the US dollar and the Chinese yuan does not devalue but rather appreciates, then they stand to lose out on the entire appreciation amount. So even though it's a risk that can be eliminated, it is not free. The other thing that you need to know and remember about these exposures is which of these hedging activities count for hedge accounting. Now, if you were hedging for a transaction exposure, then the cost of hedging would count for hedge accounting. What that essentially means is that the government believes that this is a valid operational risk that you have, and eliminating that operational risk is an operational cost, and you can subtract this from your overall sales numbers to come to your overall amount of tax due, and that can reduce your tax bill, right? So it's essentially an expense that you can get tax benefits for from a company's perspective, right? So if they enter into a contract where they're trying to eliminate transaction exposure, then they can count it as a cost and not have to pay taxes on that. However, at the end of the day, it's a cost, right? So even though it accounts for hedge accounting, that only means that they don't have to pay taxes on that component, but it still is a cost for the company, right? Now, next, let's talk about economic exposure. Now, economic exposure can be very similar, and economic exposure essentially, the book definition is that it stems from the devaluation of other currencies or changes in the economic situation of other currencies compared to the home country and the home currency. So let's stick with the same example. Let's say that Boeing was competing to be able to sell this airplane to the Chinese airline, and they were competing with Airbus. Now, Airbus is a Canadian manufacturer, right? Now, let's say at the time that these contract negotiations were taking place, the US dollar and Canadian dollar were at parity. right? Now, let's say that in the few months that followed the negotiations, the Canadian dollar devalued, right? So instead of for every US dollar you're getting uh, 1 Canadian dollar, let's say you get 1.2 Canadian dollars. So the Canadian dollar has devalued. Now, what that will essentially mean for the Chinese airline is that when Boeing will price uh, its airplanes, it will still be asking a price for 700 million Chinese yuan, because the exchange rate between US dollar and the Chinese yuan is still for every US dollar you get 7 Chinese yuan. But because of the Canadian dollar depreciating to 1.2, what that essentially means is that previously, when the exchange rate was for every Canadian dollar you could get uh, 7 Chinese yuan, because triangular arbitrage, so all exchange rates have to be the same, otherwise arbitrage is possible. Now the cross rate, because of the Canadian dollar depreciating, works out to 5.83. So essentially, Airbus will now be able to sell the same plane that was competing against Boeing, and let's say even Airbus had the same number in mind of 100 million Canadian dollars, then they will be able to price it at 583 million Chinese yuan, right? So despite the US dollar versus the Chinese yuan remaining the same, the very fact that the Canadian dollar devalued brought about Boeing not being able to successfully compete against Airbus. So this is the standard example of how devaluing a country's currency can actually mean a poor form of competition for the others, right? It's beggar thy neighbor by devaluing your own currency. So this is economic exposure, right? Now, in an economic exposure, what happens essentially is, or when is a company exposed to economic exposure? Essentially, when it's pricing its goods and services not in the local currency, but rather in the US dollars. So Boeing was, let's say, trying to sell its airplanes for still $100 million. So it does not have any transaction exposure because all its costs and everything are in US dollars. So if it knows it can sell it for $100 million, there are no transactional exposure. However, what that exposes Boeing to is economic exposure. For example, what we saw Airbus doing with the Canadian devaluation, the Canadian dollar's devaluation. So that's economic exposure. Now, economic exposure can be more difficult to eliminate, right? A, because it's not measurable, it's not tangible. And so what do companies do in order to eliminate economic exposure is they probably switch back to transaction exposure, because even though that means that they will have the possibility of having more exposure, but it's something that they can eliminate, right? So economic exposure, because it's so difficult to eliminate, it's probably better for companies to have transaction exposure. Now sometimes transaction exposure cost can be immense, especially in a situation where exchange rates are moving very fast. So companies, what they do is they set up subsidiaries in the foreign countries, and so in this example, if Boeing were to try to eliminate both transaction and economic exposure, what Boeing would essentially do is Boeing would set up a Chinese company and manufacture the planes in China for the Chinese airlines. Then all its costs would be in Chinese yuan, right? And the revenue that it receives will be void of any transaction or economic exposure. So that's the way out. And if you think historically, that's what a lot of multinational corporations have been doing. For example, if you think about the Japanese car manufacturers or even the German car manufacturers in the late 90s and early 2000s, and the Japanese car manufacturers even before that, essentially there was this period from the 70s after the Bretton Woods collapsed, that the Japanese yen strengthened significantly. In that 10-year, 20-year period between the late 70s to the early 90s, the Japanese yen moved from almost close to 300. So for every US dollar, you could get close to 300 Japanese yen to almost 150. So there was like this huge appreciation in the Japanese yen. Now that was something that forced a lot of these Japanese car manufacturers, because they had so much transaction and economic exposure, that they would get out competed if they did not move their manufacturing to the US. to move their manufacturing to the US. Same thing happened with the European car manufacturers, where they started moving, because of the euro strengthening, they started moving a lot of their production facilities across the world, in India and China and in the US, right? So, well, it's good that they were able to capture these markets and enter these markets and successfully sustain. However, translational exposure brings about, other interesting things. Now, essentially, what is translational exposure? Translational exposure typically happens when you have a subsidiary operating in a foreign country, right? And at the end of every accounting period, you translate back all of the sales and the profits and losses and the balance sheet numbers to uh, the parent company. Now you essentially have to do that because you have to report your results to your shareholders, right? Now, whenever you're reporting your results to shareholders for a company, let's say like Nike, which sells its goods and services in 100 plus countries, they cannot have 100 different exchange rates in their reporting, right? They'll have to report everything in US dollars. So what they will do is they'll have the profits and sales from the Chinese subsidiary, they'll have the profit and losses from the Indian subsidiary and from the European subsidiary, and so on and so forth. All convert those profits and losses back into US dollars and report it to the shareholders. Now, whenever they do such reporting, now remember that this is not an actual repatriation of profits. So if money was actually coming back every quarter or every end of the year from China and Europe and India and wherever the multinational corporation is operating, then that would be a different thing. However, all this is just on paper, right? So companies, because they have to report in one currency, translate back all of their financial statements from their subsidiaries and consolidate into one reporting currency, which is the home country's currency. Now, whenever the exchange rates fluctuate, such reporting will be difficult. Now, let's go back to the Boeing example, right? Now, in the Boeing example, let's say what Boeing did was they ended up establishing a subsidiary in China, which made the sale of 700 million Chinese yuan to the Chinese airline. And let's say the profit from the Chinese subsidiary was 70 million Chinese yuan, right? Now, if you translate that back and if exchange rates remain the same, then you would translate back a profit of 10 million US dollars to Boeing US, correct? Now, let's say the next year, the Chinese subsidiary of Boeing was able to sell another plane and they made another 70 million Chinese yuan in profits, right? So, okay, my camera is behaving weird. Right? So the next year, the Chinese subsidiary made the same amount of sales and the same amount of profit. However, this year what happened is that the Chinese yuan devalued. Now, because of this devaluation, let's say again it devalued to 7.5, the 70 million in profit that it made will now not translate to 10 million US dollars, but it will translate to 9.33 million, right? So all of a sudden, you see that the Chinese subsidiary did not do as well as the previous year. However, we know that the Chinese subsidiary did exactly the same amount. And the only thing that changed was that the exchange rate changed, right? So for transaction and translational exposures, a strengthening dollar is a bad thing, right? So if the dollar strengthens, then the multinational corporation loses out. And, if you think about it, even from the overall discussion that we had back in chapter 4, that, a strengthening dollar is probably good for the US only if it's importing. However, if they switch to a devalued dollar, then it might be good for exporters. But if you're importing so much, then it's not good, right? So again, a strong versus a weak dollar has its pros and cons. However, I hope that this small discussion was able to, highlight the three differences and why companies choose these different setups, right? why some companies decide to stay in their own home country, manufacture everything, and choose to have transaction or economic exposure, whereas some others, they establish subsidiaries overseas and they try to uh, eliminate transaction and economic exposure, but they end up with translational exposure. Now, again, going back to the overall discussion on hedge accounting and whether translational exposure can be hedged, it cannot be hedged straight away because it won't qualify for hedge accounting. Because it's not something that's happening actually. It's something that's only happening for the purposes of that accounting year. Now, even though it is more of an accounting gain or loss, remember that when investors are evaluating companies, they do look at their overall sales numbers, they do look at their overall earnings, and these numbers do get impacted by translational exposure, right? So even though it's something that happens on paper, there are some very real consequences to it. And the tricky thing for corporations is that multinational corporations is that it's very difficult to hedge this exposure out, because if they do hedge it, it does not count for hedge accounting because it's not actual gain or loss. If they were actually repatriating money and if there was plans to repatriate money back, then that's something that they could have hedged. But because that's a real transaction. But here what they're doing essentially is they're just making or consolidating their financial statements into one currency. It's not like the Chinese subsidiary is actually transferring that 10 million US dollars to Boeing US, right? So even though it's something on paper, investors can view the fortunes of the company, or their view of the company can change because of translation, especially for multinational corporations which have significant amount of exposures or significant portion of their revenues and profit and losses coming from outside the US. Now, when you do the final project, you will notice that companies talk about all these exposures. I want you all to understand what exposure is more important for them and what are they doing to eliminate the same. And that is, a short description of what I'm expecting in your third project. All right, thank you.